We've had 7 teams toiling very hard on the Mike's Bike simulation from 10:30 this morning, and we got done at 4:30. I want to actually first thank Smart Sims for sponsoring the event. They gave us free access to their game for the participants. Each presentation will last for 8 minutes, and we have approximately 2 to 3 minutes for questions of the teams. We have 6 judges to judge the presentations, and I'd like to briefly introduce the judges to you. We have, maybe they can wave. The judges are all sitting at this table. We have Angie Ugando, who is the COO of Global Performance, and she co-owns the company with her husband. They are in financial services planning for Primerica, and she has owned this company for 10 years. Angie Ugando. Then we have Peter Ramasa, who is the Director of Product Development for Airco, which is a commercial boiler and water heater manufacturer in the US. Peter. Then we have Suba Muralpudi, who is a Director at KPMG Management Consulting. She is in charge of implementation of global projects, and she's currently with a project at Johnson & Johnson. Suba. Justin Cleland, he's the Vice President of Asset and Liability Management at Deutsche Bank, and he basically does quantitative risk modeling with his team. Kareem Williams, he's in compliance and he's a business analyst at Deutsche Bank, and Credit Suisse, and so I apologize, Kareem. John Wirsch, who is the CEO of JPW Consulting, and their company does project and change management, and you've already heard from John. He was our first speaker this evening. So these are our 6 judges. The interesting thing is all 6 judges are alums of our executive MBA program, and I'd like to especially thank Elaine Fraser for having them, for working with them and having them come here this evening. Very quickly, we have very attractive cash awards for this evening. The top team is going to be awarded $1,050. The second team is going to be awarded $750. The team placing third will be awarded $450. The team placing fourth will be awarded $300. And teams placed in 5th, 6th, and 7th place will all get $150 each. So the awards are going to be at the end of the presentations. We're going to take a couple of minutes to tabulate the judges' scores. So I would urge you all to stay till the end, because to find out who won and to support all the presentations. So without further ado, I'm going to invite the first team. The first team is Lehman Brothers, an interesting choice of name here. And the team consists of Cordell Black. You can come over here. Karishma Patel, Sabi Rivera, and Shakira Upshaw. So they're going to be presenting first.
Thank you for coming tonight. We are Lehman Brothers, and we are going first because we are the worst. My name is Sebastian.
My name is Cordell Black.
I'm Karishma Patel.
All right. So our mission as a company, initially we aim to utilize our manufacturing capacity to its absolute fullest so that we may provide our customers with the best quality products. And from there, we wanted to take our strategy and bring forth we wanted to take our strategy and we wanted to bring the value of the strategy to the cycling community, and we want them to have fun with our bikes. So our strategy initially was to enter the market with a high quality product. We wanted to have a good first impression so that our customers would come to us. We wanted to maintain a high quality index from there so that we can retain these customers and then have a competitive pricing so that they don't go over to our competitors. We also wanted to have positive brand awareness so that others may come to us instead of going to our competitors, and then capture the market share index. Unfortunately, our strategy did not go well. So what went wrong? We had miscommunication offline and online. We had a much larger company than everybody else, so we had communication problems. Our product segments had their inconsistencies. Even though we did well in some aspects, we also had those little things that that did us under. And we also had manufacturing complications on top of that.
So we had a full array of products. We covered the entire segment of adventure bikes, racer bikes, leisure bikes, commuter, and kids bikes. So I'm going to be going through a little bit of, on the left you can see what our recommended or our target ratio was that we were hoping to reach to maintain a positive balance throughout our Mike's Bikes experience. And on the right you can see the actual amount that we inquired. So in adventure bikes, you can see public relations. We've highlighted the ones that are most stand out or the most a little off of our target. Public relations, we targeted for 0.20 and we ended up with 0.04. Distribution was at 0.5 and we got 0.07. And product specs was at 0.80, but we only received 0.16. For adventure bikes, we also had produced another one, but we never got the ability to launch it because of financial constraints. For our racer bike, for public relations, our target ratio was 0.40, and we actually ended up with 0 completely in that one. Distribution was 0.50, and we had 0.04. Our product specs were 0.95, and we had 0.72. For leisure bikes, awareness and delivery were off. We had 0.7 for awareness, and we ended up with 0.49. And for delivery, we had 0.9, and we ended up with 0.60. And for our commuter bikes, we had distribution, which was at 0.50, and our end results were at 0.14, and delivery, which was a 0.9 ratio, and we ended up with a 0.49. The last one for kids bikes, we had distribution and delivery at 0.4, which ended up at 0.13, and delivery, which was estimated at 0.80, and we ended up with 0.61.
And now with our DuPont analysis. As you can see, in 2015, we had a substantial loss. But as we escalated through the years, our loss grew a lot much bigger. The reasoning behind that was because when we first started out for our first year of decisions, there was a miscommunication that happened, and we all take fully responsibility of it. However, we had to have a high target. We had to maintain a high target for quality. And unfortunately, we don't have it represented, but our first, after our first decisions and within our first year, we had a quality index of 0.69. So if we're competing against 7 other companies in the same industry and they have a quality index of 0.8 or 0.9 or even higher than that, you can almost assume that we were doomed from the start. Our return on sales was negative 32%, unfortunately, due to our negative net income for each year. We did maintain positive sales, however, after all of our expenses and liabilities, you can almost see how our net income had began to diminish. ROA had a negative, our return on assets actually had a negative ratio of 166.50%, which is probably the record high amongst all groups. But it's just, as you can see from these ratios, it just was a lot of things that we didn't aim or we didn't even achieve our target. So each year our debt actually grew exponentially up to 1,823%. And that's because most of our company at the end was financed through debt. I mean, we didn't make any money. We kept losing money, and we overdraft each year more and more and more. Our strategy in the beginning, again, was to maintain a high quality index and offer favorable pricing so that way we could actually maintain a high market share index. But when that quality had failed in the first year and when we accumulated all our advertising costs, our high salary as well, because we actually end up hiring a lot of employees. We wanted to grow as soon as possible. That's why we had all 4 bikes done within the second year. But again, after that quality index had failed, everything else kind of followed as well. Some other things I want to cover. And as far as manufacturing, again, our quality index started at 0.69, but after we ended, as you can see, our quality actually grew to 0.92 or 0.91. I'm actually not too clear upon that. And the reason for that is because our first year, when we put into our quality systems, we invested an amount of only $300,000. Now, with increasing that to 1.5 million, we were able to increase our quality for our bikes. And that's what actually started to retain some more customers, which driven up our sales. However, because of all the liabilities we accumulated and also not paying back some of our loans and the overdraft fees, we were never able to possess a positive profit. Again, also our plant size was, and our employees were substantially high after our first year decisions, because we thought as we were launching these 4 bikes, we wanted to actually produce more than everyone else. We wanted to offer better quality. We wanted to offer a cheaper price. However, our plans didn't go accordingly. And our batch size that we had inputted was incorrect from the start. When we first started off with the company, when you only have a minute number of bikes, your batch size should be small and relatively small to that minute size. When we say that we had a batch size inputted incorrectly, our company would literally wait until there was 2,000 bikes produced before they would ship them out to our distributors. So this was also a big failure upon our part. And also, due to all the financial constraints that we had, throughout the 7 years, we weren't able to offer our employees a raise or any type of encouragement or any type of motivation. So that also dropped down our sales and also dropped down our manufacturing. So in the end, we're Lehman Brothers.
So in the end, history ended up repeating itself, and we lived up to our name, and we had the worst bankruptcy in all of Mike's Bikes history. Thank you.
Are there any questions? Specifically for anybody?
Yes.
Yes. Of course.
Yeah.
Of course. I mean, I wish we could have presented our class results, because our class results, we had a market share price of $171. This one, we had a market share price of 1 cent. So.
Yeah. Knowing where we went wrong, we definitely would do it again.
Definitely.
But the game is very, very enjoyable, and it also teaches you a lot about how many different factors goes into a business and actually running one accordingly. So it actually is a very fun simulation. Yeah. We had a great time.
Yes.
Very, very good presentation. It takes someone like you to actually start something like this. Very, very good.
Thank you.
I was very pleased. Just wanted to know if there are 2 things that you would do differently, what would they be? I don't want finance, no numbers.
No finance
just
and numbers.
philosophically.
Okay. If we could have did it differently, we would have raised up our quality to the appropriate place where it should have been, and we would have reduced our advertising costs. Because each advertising cost, well, you don't want the numbers, but yes. What were you saying?
But I thought your quality was very close to the others. You said you have 0.69, they have 0.8.
By 2022, our quality raised to close to everyone else's by the end of the year.
And
within the first 3 years, our quality gradually increased from 0.69 to 0.71 to 0.74. It gradually increased. It
yeah,
wasn't
and
just
with the quality being 0.69 and all the other firms having them up in the 8s, we had no chance.
Okay.
Yes.
Thank you.
Yes.
Yes.
Taking on the strategy of running a high-quality bike but offering basically below-market pricing creates a perception that your brand is of lower quality, hence the results, I assume. So you made a comment about that you want to reduce your marketing costs even more. Do you think that would be the appropriate strategy given what the results showed you from a high-quality competitive pricing but low-quality index?
Well, again, we couldn't really present off of what we did in the class, but we were following a similar strategy that actually took us to this competition. When we started off our competition with high quality and relatively low price. However, we would come out with a duplicate product that would offer the same type of quality but a higher margin price. Basically, subtracting in between, we would offer the lowest price for a racer bike, and also the highest price for a racer bike. And both of the qualities would match. So being a customer and being in this simulation, we would actually make profitable sales off of the lowest bike and also the highest bike. And it would be a tight constraint for our competitors to follow as well.
Yeah.
Yes.
In what year did you, let's play this out in real life, and you were working for this company, whether it was your money or borrowed money, what year were you walk?
I'm sorry?
And what year?
Would we walk
Oh.
away? Oh, man.
We were trying to cut losses after 2018, after 2018 going on to 2019, because we actually ended up getting a cash injection, and again, it still didn't do any good.
But did you see, when was the no return, I guess? When did you actually know in your mind there was a no?
Probably the year after our third year, when we had reached a negative cash balance of $45 million, over negative $45 million. So that's probably when we would have just cut our losses.
Came in and you still took it.
We still took it, we still tried it, and it didn't change anything around. It was almost like just trying to, breathe some pulse into the company, but it never came back alive. Any more questions? All right, thank you guys. You have a good evening.
Good evening, everyone. Our company is Lady Hawks, and we will go over a brief overview of our performance. Our company roles are,
Hello, my name is Christine McIntyre, and I play the role of Director of Finance and New Product Development.
and I'm Tiffany Hoover, Marketing and Public Relations.
I'm Diana Castro, and I'm Information.
For our company mission statement, Lady Hawks promotes cycling as an effective and healthy option for exercise and transport. We offer a full line of products and services for the cycling community and consistently strive to offer affordable, high-quality, stylish products. We're committed to building a more bicycle-friendly environment while providing expertise and unyielding customer service. So basically, we launched 5 bikes and 5 market segments. We had a kids bike, an adventure bike, a commuter bike, a racer, and a leisure bike. The first bike, adventure bike.
So the very first market segment that we entered was the adventure bike segment, which is the default for all teams. So initially, all the bikes were priced at $1,600, but because it was the first year, we decided to have a low price strategy. So we actually decreased our bicycle price to $1,535 because we wanted to be lower than the competition so that we could pretty much gain market share. Unfortunately, that price was too low as compared to all the other teams, which remained in the $1,600 and $1,700 range. So we increased our price in order to just remain in the range of the market price. In 2017, however, we actually lost a lot of sales. So in order to regain our market share and to sell the excess finished good stock that we had, we actually dropped our price to $1,474 and $1,475 within the next year. And as you can see, our price gradually decreased over the years in order to pretty much just sell off all of our remaining stock. The numbers you see to the right of the screen are actually our final year's sales. So we made more bikes than we were able to sell. Therefore, our gross margin was negative.
Our next market segment was kids, and since we were laggers to the market segment, we wanted to have an introductory price, so we launched a bike at $300. We reduced it to $250, then $220, in order to sell our products. And the overall end, our gross margin was in a negative $141.26. Our sales revenue was $621,478, and our cost of goods was $762,704. The next bike market segment was the racer, and we launched a bike called Racing Hawk. When we first released it, again, we were last to the market. We had an introductory price of $2,700. We were below competition, so we decided to increase the price of the bike to be more competitive to $3,000. And since we didn't sell any of our products, we reduced it again to $2,700, which we remained throughout the rest of the years. And as you can see, our sales revenue, cost of goods, and gross margin was 0.
Okay. In the commuter segment, we have the Flying Hawk, which we launched in 2018 at a starting price of $240. And as years pass by, we continue dropping our prices just so we can actually sell our products. But as you can see, our gross margin remained negative. In the leisure segment, we have the Soaring Hawk, which was the only segment where we actually made a profit. We started at $200, and then we continue reducing our price just so we can sell our products because we had so much good in stock. And our gross margin was $95,499. In terms of performance, we were really bad. Because of our low performance, our market share was 3%. Our numbers of shares was 2.9 million. In order to gain cash, throughout the years, we continued selling our shares, which affected our share and economic price.
Okay, so in terms of our financial analysis, in 2015, we were actually the top performer. However, we made a critical error, which I'll later discuss, which caused our return on sales to continuously drop as our net income dropped. Our debt to equity increased over the years. There was one point in time in terms of inventory that we had a better handle on our inventory turnover because we were pretty much managing our inventory a lot better at one point in time because we weren't holding so much goods in stock. Our current ratio continued to drop as we didn't have enough current assets to cover our current liabilities because of the poor performance of our company. And in terms of return on assets, again, because our net income was negative, that number became increasingly negative over the years as well. So where did we go wrong? It pretty much started where we made a critical mistake in the very first year where we underestimated our competition. And the first thing we did was increase capacity so that we could produce more products. However, we failed to develop any new products. And we pretty much relied on the one market segment that we were in, which was the adventure bike segment, which didn't work in our favor. So because we had spent so much money on increasing our capacity and not developing any new products, we actually lost a lot of money that we couldn't regain. In all the other market segments, we entered them way too late. They had other companies who were already established, and then we came and we tried to have lower prices, but by that point in time, we didn't have enough cash to do certain things that we needed to do, such as advertise those products. We did receive an emergency cash injection of $13 million, but again, we were so far in debt that there was really nothing that we could do. We cut a lot of costs in areas where we could, but those areas that we cut costs in were critical areas, such as advertising, quality, areas that we actually needed to keep money in to sell our bikes. And we continued to reduce our expenses. Again, it was in areas that we needed to have money in. So in the end, we pretty much failed to recover all the costs that we lost. And we ended up negative, I believe, somewhere in the 80,000 or so. So that's pretty much where we went wrong in the game. Are there any questions? Yes.
Your strategy reduced costs, reduced sell price. Why did you think that would improve sales?
Well, it wasn't so much to improve the sales. It was just because we had so much finished goods stock. It was just to sell off the remaining stock that we had. Our initial strategy was to come in at a low cost, pretty much to capture the market, which didn't work to our favor because we didn't put money into areas such as quality. So other teams, they had quality that was much better than ours. Their brand awareness was much higher than ours. But by the time we were able to realize where we went wrong, we didn't have enough cash to improve those areas. Any other questions?
Thank you.
Thank you.
Yes, we are the Texas Rangers. Forgive us for coming in fifth. We were expecting to win the tournament.
We had high hopes.
As it says in our mission statement, while anyone can fashion a pair of wheels together to get you from point A to point B, at Texas Rangers, our mission is to give riders a connection with the road that no other cycle can match. Once you start turning our tires, consider yourselves a champion of the terrain.
So at the beginning, we wanted to keep our strategy because we won the game. So our strategy was having a low price, a low distribution engagement, a high volume of sales, high margins, and a high research development. But we failed because we made some mistakes, which lead us in 2018 at a share value of $2.71. But we changed our strategy, we tried to recover, and we finished the game in 2022 with a shareholder value of $17.10 at the fifth place. And now we will explain you in more detail what happened.
So what really happened was we made a crucial mistake in the very beginning. What we ended up forgetting was to purchase more land with our low-cost strategy. So to make up the margins, the strategy was to sell a lot more by being able to produce more. You can see basically off this graph what happened. We're the line in red. We're kind of singled out by the bottom there. Rate it 2016, is that? The second year, or third year. You can see that we drop off incredibly, and that is because that's the year that the new bikes came into the market, and we didn't have the capacity to produce the amount that we would have required to be successful. So we ended up making 3 bikes instead of 4 because of financial constraints. In this slide, it shows you how we did our capacity. So in the first, in 2016, we realized our mistake. And after we finished kicking ourselves and groping around and almost giving up, we decided to pick ourselves up by our bootstraps and figure out a strategy to recover. And so this involved not only getting out the capacity we needed, but in the later years, it involved, we ran out of cash basically, because we took out a lot of debt to make up, to get into the markets that we weren't in with the effectiveness that we needed. So we ended up selling off capacity to basically liquidating our company just slightly to an amount that we could still survive to create the cash we needed to fix our company. This shows basically how once we had the efficiency, that pretty much fueled our recovery. And the only plan we really had at the end there was to make sure that our efficiency kept at the levels that we needed to be able to keep our sales increasing and to fix our shareholder value. And now I'll be giving it off to Darius.
In our financial statements, you can see that during the first 3 years, we were careful not to risk borrowing to endanger our company's financial standing. But unfortunately, due to the decline of our company, as we were not able to really jumpstart our production and our sales, we had a heavy decline of assets in 2017. Thus, as you can see, our liabilities reached the highest levels, and our debt to equity was almost near a leverage of 2. Thankfully, our risks did not go beyond that. We were continuously tampering with our debt structure, frantically questioning whether we should borrow or not, and whether and how much to sell off our equity to raise funds. We luckily were able to find the cash we needed to increase our production and improve our sales. in our ROS, as you can tell, we started off 2014 with a 15% ROS, roughly on equal footing. Unfortunately, 2015, we operated our first and only year at a net loss, a fairly substantial one, which I admit wiped away our first year profit. Nevertheless, we tried earnestly to compete with the other firms, and luckily we maintained a profit at least in every other year. During 2019, you can see our substantial growth from our recovery. It shows our 5th place status, our determination not to go bankrupt. Thank you.
So basically, what did we learn? Based off our efficiency, we were able to play on our strengths and recover. So basically, we were the only company to, come real close to bankruptcy, and without using a loan or anything from the moderator, our teacher, we were able to recover just off ourselves, almost like a Chapter 11. We reviewed what was wrong, and we got back into what we needed. We realized that our changes in our strategy weren't enough to come back and be the comeback kid. So time management was really our main problem. Thank you. Are there any questions? Well, almost quite literally, our only real mistake was not putting in, pressing a couple keys like 2, 5, 0, 0, 0. So really making our capacity not increase. We had built a low-cost structure, so we had the workforce we needed, but they were basically sitting around doing nothing because we didn't have the space to produce. So while switching to a high-cost strategy and then switching back to a low-cost strategy, trying to restructure ourselves into a low-cost strategy, it killed us, but we were able to recover.
So actually, to build on it, your mission statement came out, and I was excited. It's going to be high quality, awesome. And then you said, oh, we're going to be low cost.
So we had low costs, mostly. We had high quality. We figured out by investing in research early, there's basically expenditure for the research for each bike. We realized that by doing that, you lower the prime costs dramatically. And by lowering prime costs, you can basically outrun the competition.
Our intention was to dominate the high-quality markets in the racer and adventure bikes. And in doing so, we would always lower our margins to the lowest of 35 at each store, chain, and distributor. So we would have the lowest price, even though we'd have the highest quality bikes in those high-priced markets. I suppose our biggest error was a bit of hubris. Like Humpty Dumpty, we fell down. And we were the dominant group in the morning class, so this was a good lesson for us to not rest on our laurels.
Good evening, everyone. My name is Danica, and these are my partners, Arno and Nina. Our company is called DNA Bikes. As Professor said, we ended up on the 4th place with a shareholder value of 26.70 cents. We need to admit that we had higher expectations, since in first 4 years we had a rising trend and we were constantly growing. And then we experienced a slump in 2019, which cost us the market's leader's position in the end. However, our shareholder value is very optimistic compared to our closest competitors, since trend analysis is showing also increasing trend, which is also giving us a space for growth in future potentially. When it comes to our mission statement, we at DNA strive to delight our customers by constantly developing new technologies and making their riding experience amazing. Our goal is to produce high-quality, long-lasting bicycles within diverse markets. Customers are our main priority, and we build bicycles specifically to fit customer needs, but also to gain their loyalty by improving their previous riding experience from an average to the extraordinary. The name of our company can also be summed up in 3 main features of our mission statement, which is delighting, new, and amazing. Furthermore, the name of our company is not just related to our mission statement, but also to organizational structure and our strategy. We actually work as a corporate DNA metaphor, meaning that as every other body from the biological standpoint carries the DNA, which is carrying the core concept, rules, and information for body to function properly. And the same is happening with our organization. We had a DNA in our initial stage of the game, and the strategy was to enter all bike segments and rely on product differentiation in those early stages. And then, as you can see in this small illustration on the side, down the road, we had to adapt to saturated market environment, and we transformed to low-cost strategy followed by dumping pricing strategy. And now Nina will talk more about key strategy through different growth stages. Here you go. When it comes to our key strategies, we focused our goal to be in the early stages market penetration and capturing market share very early in the competition in order to take the first mover advantage and to gain customer loyalty, which will keep us stable in the next stages. In the maturity stage, our goal was to focus on production efficiency and customer loyalty, which means that we wanted to be as efficient in the existing markets as well as enter new markets and to have capacity which will support us to produce products in these new segments. In the decline stage of our business, we wanted to focus on finance activities and bring back our shareholder value because of paying off long-term debt and repurchasing shares in order to boost our shareholder value, which was the measurement for the overall performance. Our financial objective in early stages was increasing capital to support our production and rapid expansion. So we relied on issuing long-term debt as well as issuing shares in order to increase capital and invest in our production and employing a workforce which will support our production and marketing activities. In maturity stage, we wanted to be capable to invest this cash effectively and not to go further in the debt, but moreover to start paying off the long-term debt. And eventually in the decline stage, we wanted to start repurchasing shares and paying dividends in order to increase our shareholder value, and as well as liquidating unneeded equipment which we had not needed for our production anymore. Our main marketing objectives in the early stages was to have high advertising in order to establish brand recognition early in the competition and invest also in the distribution relations, which would give us our products in as many as possible retail stores. This strategy of investing in distribution showed very successful in our early years of competition and give us really a big competitive advantage. In maturity stage, we wanted to hold and stay successful in the existing market and also promote new products in the segments that we entered in the maturity stage. And in the decline stage, we wanted to focus on the cost-effective moves, which means lowering advertising as well as PR investing in order to decrease our costs, which would allow us to decrease also our prices and stay competitive in terms of pricing strategy.
I will continue talking about the competitive advantages we had in the business world that we competed in. First off, and most importantly, we were the market leader in the dominant bike, which is the racer bike, and also in the adventure segment. Also, we were third biggest market share with 19.2%, which is only 1% lower than the market leader that at the end of the day had the biggest shares. Next off, we had the third highest economic value that we created throughout the 7 rollovers that we had, and also the second highest dividends per share. As Nina already said, that during the last 2 and 3 years, as our cash grew, it became very important to us that we started to pay back and get our dividends per share up. As you could see in the graph before, we had a sustainable ending cash balance of over $13.5 million US, and obviously sales profit and positive cash flow and net profit of $6.2 million. Also, we had high level of product diversification and quality, because that was from the first point on our strategy. We wanted to be different than everyone else, and we wanted this by quality and especially also by our pricing strategy. Finally, as previously mentioned, we had one rough year and we were able to bounce back from it, and this was due to the market response of 2019, and I'll continue with the potential reasons for the decline. We think that, or we know that it was pretty much because of wrong market research that we did, or sales forecasts that we misread and misinterpreted. And we just couldn't sell all of our bikes that we produced initially, which led to high inventory costs, and that cost us a lot of money at the end of the day. Also, the high cost of goods sold in the adventure product in that line, and also the strong competition, market saturation, since the adventure product was already in the mature state in the 6th year, I'm sorry. Lastly, our future outlook to keep increasing shareholder value, obviously. We want to please them. Our increase to dividends per share, since this is going to boost our shareholder value, and increase plant efficiency, as well as we would like to expand globally, since we have the cash available after the 7 years that we can expand and go into different markets. And thank you for your attention, and we'd be happy to answer questions. Yes?
Great presentation. Quick question. Why were you the market leader in racer and adventure bikes? What did you do that made you the market leader?
First of all, we initially focused a lot on advertising, which really, as well as on quality, which differentiated us among competitors. But at the same time, we start lowering our prices earlier than our competitors, which gave us, which increased the demand for our products in the market. When you look at the same quality but lower price, customers will always choose one with the lower price. And same thing was with the racer segment.
Your mission statement said that you're constantly innovating your bikes. What were the innovations with that?
We were trying to.
We were constantly modifying our bikes,
Yeah.
because specifications of bikes, as the time grows and the market demands and the needs change, specifications of the bikes change as well. So we looked at the perceptual map of market in order to always be in the bullet and meet needs of the customers, and we were pretty successful with that, and it also really contributed to our performance.
Yes.
When you lowered price when you lowered the price in the, I think it was the adventure or the racer,
Yes.
In the 2nd year, did you see an increase in volume, and how much, and did it meet your expectations?
We saw increase, but then as we went further, we were keeping to decrease our prices. However, we didn't meet our goal because of our low advertising, because of our strategy to lower advertising as we were lowering prices. But the numbers, it's very hard to play with the numbers, so I guess our ratios were not as we expected them to be, and that it resulted in 2019 in very big failure of our profit, and it resulted also in the decline of shareholder value.
We just didn't sell enough products, which lost sales and then inventory. Like inventory was the biggest thing that cost us a lot of money.
What went into your decision to issue debt as opposed to potentially using equity?
Because in the game there is certain amount, maximum limit of how much shares you can repurchase. So we didn't want to be stuck without being possible to repurchase shares in the decline stages. So we relied on paying off the debt and starting to repurchase shares in the 4th year, so we can repurchase as much as possible in order to increase our shareholder value and to keep up with the competition.
Just a quick follow-up on that. Do you think, let's be outside of the game for a second, but what's your thoughts on repurchasing that high amount of shares? Do you think that's the best thing for the company and your brand and your investors, or?
I think in the real world is not, but in the game it showed up as really boosting shareholder value, and it affected our performance, so that was our strategy.
Well, IBM has been doing a lot. Stock repurchase.
Yes.
To inflate stock prices. Coming back to the inventory that you mentioned there, Arnold, it seemed your strategy was very different from the other groups that have presented. You went with a high cost, a high quality, which I liked a lot, and you differentiate yourself from everybody else. Also, I noticed that in the 3rd year you had a lot of inventory, you had a lot of lost sales in every segment that you entered. Do you know why? Why were you not hesitant to? Why were you so hesitant to thinking that it was worth producing a higher number?
Until now, I think the biggest thing that we had, and I think I can speak for all of our groups, it was the time. That was our biggest enemy, and so it was kind of hard to exactly read and interpret the market correctly, to exactly know how much to produce, how many SKUs to purchase in order to have enough factory and enough people that you hire. And eventually, at the end of the day, if we had probably more time between the rollovers, I think we would have figured it out, because we could have lowered our inventory, and due to that, we wouldn't have lost that many sales.
I would also just add on it that I think that it wasn't our big mistake that we made that resulted in that decline in 2019, but the high competition from the other members of the market. So that's why we didn't expect that failure, but it appears as other competitors in our market were really doing good in their adventure and racer segment.
Just one more question. So you said that in your problem year, between your problem year and your real year, where you recovered really well,
yeah.
You were able to figure out what went wrong, or you just, what was really the changing factor that helped you guys come back?
First of all, the reason why we went down was we decreased advertising by a lot, and in order to be able to decrease prices. But in this phase of the competition, it wasn't very good idea as showed here in 2018. However, in the year 2019 and 2020, this decrease in advertising and decrease in prices shows to work very profitable comparing to our competitors. So this strategy was actually a good strategy if we didn't establish it earlier. So we should wait a little bit longer, you know, to cut our advertising and our prices. But we were able to come back and be very close here, 4th place.
No, not another question, just a comment. Just to point out that you had a 50% decrease in the stock price, and 2 years later you were able to bounce back over to what you were at the high point. That I think is remarkable.
Yeah.
I think it's your judgment in figuring out what was happening in the market and what everybody else was doing was pretty good.
Thank you.
Thank you.
Question here, and it is a non-traditional question, and it is very appropriate to this group. I know you all play competitive sport, and in sport you have your... I'm saying this question is very appropriate to this team because they play competitive sport. And as such, I know in sport, you will be dealing with opponent which you can see right in front of you. Now, the game when you were playing, you spoke a lot about your opponent. So most of the time you are imagining, thinking what they may do. You don't clearly, see them like you do in sport. So using that analogy and that metaphor, if I can say so. Can you tell us a little bit, how is this type of gaming business different from the physical sport?
I can go first.
All right, go ahead.
I think that just like in sport, we were very intense in this competition and very aggressive in our strategies. And as any game in the sport, you also win and lose. So we had that loss in our year 2019, but then you can see that we didn't give up. So we came back 2 years later with double amount of our shareholder value. So I think that's a positive thing that we can take from this game, and that also relates to the sport, like never giving up. And I think that maybe by 2024 we might even go to first or second place again in market leaders position. And teamwork, obviously, yeah.
Hi everyone, my name is Bia, this is Haral, and this is Cal, and we're Cycle City Incorporated. Okay, so our mission statement was that we want to manufacture bikes that have the world-class features that allow all bike lovers to ride them effortlessly. Cycle City Incorporated is dedicated to manufacturing high-quality bikes. We seek to maximize returns to investors, aspire to give back to society, and lastly, provide customers with safety and satisfaction in mind. For our growth strategy implementation, we chose a low-cost strategy. So initially, we wanted to gain high market share in order to efficiently sell our products later on in the years. And we also did careful planning. So we took all segments into perspective. We looked at the price, the product, promotion, and distribution. And lastly, we budgeted our finances. Some of our company goals were to maximize our shareholder value, take entrepreneurial risks of more expensive bikes and profits. We also wanted to introduce new products, eliminate any debt that we had, and to be efficient while keeping our quality high.
Right, so this is the product that we designed in 7 years. In 2014, we designed 3 bikes, and 2015 we just designed 1 bike, and 2016 we designed 2 bikes, and in 2017 we designed another 1 bikes. So this is the market share chart that between the 7 companies, and as you can see, for last 7 years we had highest market share. We invest more in advertising and PR, so we maintain our quality for the last 7 years. And this is our shareholder value chart. In 2015 we made wrong forecasting, so in the first year that's why we went down, and in the 2016 we fixed that wrong forecasting, like we launched the new products and in different segments, so that's why we went up. And in 2017 we went up because our strategy we was working on in 2015 and 2016, it's paid off in 2017. And 2018 we went down because we had too much idle time. We have more capacity and more employees, so that's why we went down in 2018. So we try to control in 2019, and we cut down a little marketing and also PR, and we try to cut down idle time. So in 2019 and 20, that's why we went up, but in 2021 we went down because our sales was decreased than previous year. Okay, go ahead.
This is our ending cash balance for 7 years. In 2015 and 16, as you can see, we have negative cash balance. The reason why we have negative cash balance is we had sales forecast that we made was wrong in the first initial year, and also the reason was it was decreased because we developed 3 products in 2015. In 2016 it also went down negative because the reason was we invested in advertising and PR too much heavily and too high. That's why it paid. That's why it paid off. That's why it paid off in 2017 and 18. The reason why we have ending cash balance too high in 2019, we invested too aggressively from 2015 to 2018 in our advertising segments and PRs and quality and everything. We cut down the prices after 2008, starting cut down prices. So it went up drastically, like 20 million. And in 2020, it did the same thing because we cut down the idle time and also with the less workers and everything. In 2021, we had lost sales for all the products. That's why it went down to 26 million. This was our shareholders' value from 2015 to 2021. The initial, in 2015, we had 581. The reason why, again, it was our forecasting was wrong, and we forecast too high and with the low cost. And also we developed developed too many products and invest too many cash. At that time, we did not have cash in 2015. In 2016, we introduced 3 more products and developed 1 more product. That's why our cash balance went too high and our prices were too low for the competitors. Competition was like really hard to get there. In 2018, the graph went down. The reason why it went down is because of our too much idle time in 2008, and also there was too much inventory for that. The total share equity at the end we gave out was 30 million. After we were giving back to our shareholders, we were repurchasing our shares, and that's the reason why we have higher amount in the last ending years, because we were making, at that time, we were making too much profit in those years. That's why we try to give it back to the shareholders, and plus we repurchase our shares too at that point.
Questions?
Any questions?
Any questions?
Right.
How do you know which one to choose first?
We were like introducing new products initially and taking a risk. Both of them we did it in our first year because we invested heavily in all the segments and also in advertising and PR.
But you made too much of a risk. You may not maximize shareholder value. That's what I mean. How do you know which one you do more so than the other?
We actually did our all the calculations and everything, and then we went in with this strategy and our company goals. Like in initial years, we knew our share prices will go down, but at the end we will capture our market and shareholders value too, because our initial was we cut all the cost in the initial year, and our advertising and branding, we were building our image in first couple of years. That's why that's how like the company goal was to invest heavily in advertising and PR and branding. Right. Right. The reason was in 2020 there was decision made, and it went down because we tried to cut down our manufacturing sector. We made a mistake over there by cutting down. Because of that, we lost the sales over there. That's why it went down drastically. And in 2020, we did not make any decisions. It just rolled over to another year. So we did not make any decisions in 2020. That's why it's dropped down. And we are already in our development product. We are 2 products were in the line for development. The reason why in 2018 it was our manufacturing capacity was too high. So from that we were like, we have to cut down, and we made wrong decisions. And in 2020 we did not got chance to look over our stuff, and it was time to go, so they rolled over. Otherwise we were second by 50 cents.
Yeah, almost.
In your mission statement, you talk about giving back to your shareholders, but of the solvent companies, you had the lowest dividend per share. How do you justify that? Sitting on cash. Yeah. Sitting on 26 million cash.
We did give out the dividends, but we were waiting until like last 2 years to give out the dividends to when we make a lot of money, to give out to show our confidence. We gave out at the end of the moment. We gave out like 35% of dividend in last 2 years, 25 and 35% of dividend in last 2 years.
25 cents.
25 cents. I'm sorry, 25 cents and 35 cents.
So you weren't sure what to do with the cash.
Right. We were like making the decisions like to develop a product or not to develop. We had the reason why we end up in a lot of cash, because in 2018-19 we sell a lot of capacity from our manufacturing. That's why it's showing that we have a lot of cash. Otherwise we did not have that much cash as it was showing in the last year. Our strategy was to the commuter bikes.
What was your strategy of having 2 competitive bikes in the same market?
It was not in the same market, 2 bikes. It was innovation, like more design and like specification. Yeah. No, it was not.
But on the kid's bike, you had just another kid's bike.
Yes.
And then you had 2, or was that just a redesign?
It was a redesigned bikes that we made because of the product and the market, whatever the market was like, they need which bikes to. That's why we made the 2 bikes of kids and commute bikes, and also laser bikes. The laser bikes we made 2, and
Was the first bike not meeting the market expectations?
Well, also, we knew some of the other teams were doing poorly. They were actually going bankrupt, so we actually took advantage of their market share, and
so that's why we try to innovate some of the bikes. At the end, it was too late to redesign our adventure bike, so we did not made. But if we had got chance, we would have developed another adventure bike.
Quick question. Go back to your ending cash balance slide. Thank you.
Yeah.
It seems like your ROE in the first 4 years was pretty good, impressive, but then that number dropped significantly because it seems like you were very concerned about your ending cash balance and tried to increase that. There was no problem with that, but after year 2019, I didn't see you like points made earlier. You did not do anything with the cash you had. You did not modify one of those bikes. You could have done something differently. What would you do?
The thing was, in 2019, we tried a couple of things. We did not have enough time, but in 2019, we tried a couple of things to innovate new bikes and making it to the market, but it did not work. In the market, there was another product specs, it was working. That's why it did not, that's why we just left with that much cash. And also, in 2018, we sold a lot of capacity, and that's why, and we also decreased our workers. That's why it went, we have a lot of cash in 2019, as you can see, because in 2018, we started decreasing our capacity.
We actually get some comment on that from other members of the group as well.
Yeah, sure.
Same question. I just wanted to hear what somebody.
Okay, so in 2018, we cut down our idle time and also we cut down our employees. So that's why in 2019 and 2020, we went up little more. We went up like little high, and also we changed some amounts in advertising and also in PR. So that's why we went up little bit.
Good evening, ladies and gentlemen. My name is Kashif Usman, and this is Ahmed Mohammed and Sim Singh, and we are Stratton Oakmont. No, we're not the penny stock boiler room brokerage firm. We're in the business of making bikes. I'm the CEO, COO, CFO. Here at Stratton Oakmont, we want to produce bicycles that are readily available to a wide range of consumers while benefiting the environment and surrounding communities. At Stratton Oakmont, we believe that no market should be left behind. We produce bicycles for all segments of society. For those who are adventurous, for the racers, for the kids, for those who are in it for leisure, and for those who'd rather not leave a mark. But then again, not all markets are created equal. Throughout business, we realized that our racer bicycles have proved to be the most successful bike with a gross profit margin of 72%.
Hello everyone, I'll be describing our general strategy and our financials as well. So our basic strategy was to basically increase capacity from the beginning. We knew we wanted to penetrate all the markets, so initially we double plant capacity, double workers. So we had to be flexible. We had to adjust to demand. So we constantly had to adjust for segment sensitivities, pricing, demand. One of our general strategies was to maintain high quality of 0.9 plus. You guys heard other teams had like 0.6. We had consistently across the boards 0.9 across all years. So that required major investments in quality systems, preventative maintenance, salaries, inspection. We made sure that our salaries increased every single year. So that meant workers were more motivated, they performed, they were more efficient. So our initial rounds, from the get-go, we raised max equity and debt just to have like a cushion, just in case anything came up, just in case of like bankruptcy or whatnot. Penetrated all product segments, and then our strategy for the equity was to repurchase 10% every single year. That way, our earnings per share were higher. Significant investments in R&D for low prime unit costs. So for each bike we produced, we made sure that we were maximizing gross margin on each bike. Maintain low cost again. So our main strategy was to penetrate the market using a low cost strategy, and then afterwards, like around year 2019, we actually increased the prices. That way we can just increase the profit margin on all the bikes. Again, we had to be flexible. We had to adjust planned production to meet demand, and we had to avoid overproduction because we didn't want current liabilities to be as high. So our final rounds, we kind of, pulled everything. We pruned the company. We wanted like a more lean company, so we cut capacity, cut salaries, increased prices on all bikes again, just to increase gross margin. And then the last 3 years, we actually issued dividends of $1 in 2019, $2.80 in 2020, and then $2.80 again in 2021. The last two rollovers were weird, where you can make one decision, and that decision applied for both rollovers. And that'll come up, and then we put $5 million into investor relations just to boost up our shareholder value. Results of our operations. So again, if you guys look at these are each of our bikes. We maintained high gross margin, so 60% on the adventure bike, 78% on our cash cow, which was the racer bike, 60%, 45%, 51% on the commuter bike. Again, gross margin, we had to maintain the margins. Results of our operations, so our revenues. So our revenues from the get-go, they increased dramatically, and then they improved, slightly, but it was consistent growth across the board until 2020. That's when we kind of cut advertising. We lost customers, but again, we increased the prices, and that really helped with our shareholder value and our profits. Here, so it's kind of skewed because Lehman Brothers kind of like ruined the whole, because they went bankrupt. But our profits actually, so we got the highest profits in 2016, and then again in 2020, and then we maintained a good profit margin for 2021, which is pretty competitive. We've remained competitive across the board in all segments and all operations. Shareholder value. So Stratton Oakmont, as an investment, would you invest, right? So in December 2015, Stratton Oakmont shares sold for $13.82. In 2021, by the end of it, they depreciated to $35.28. And so so if you look at the red is Cycle City, they won first place. We were pretty close with $35.62. I think the difference was negligible. It was like a $2 difference. But if you look at, we did some financial statement analysis, and we figured that if you look at our net income, so net income has been dramatically increasing, except for 2015, because 2015, that's when we invested a lot into plant capacity and whatnot, so we actually took a loss. But afterwards, our net income was increasing again in 2016 and went down 2017 because capacity went up, and then after that, it went up dramatically from 2019 to 2020. And then you want to look at cash flows. For our cash flow statement, the ending cash balance was an unbelievable $31 million by 2020. So alternative ending, financial results for all firms. If you look at, so we went up to 35.68. Our competitors' first place went up to 39.10. But we actually did an analysis that if we actually used the ending cash balance to invest in increasing dividends, investor relations, we would have wound up with a whopping $62.78. So yeah, and then you want to look at our market cap. Our market cap is higher than theirs, plus our total shareholder value is higher than theirs. Yeah, Sim?
So I'm going to be discussing the future direction of our company. And they say the future belongs to those who prepare for it today. And at Stratton Oakmont, we make sure we exhaust every resource and every option to ensure the success of our company, our employees, and our shareholders. And as you can see by the actions that we took within our game, they were clearly indicative of a firm who seeks to grow and to continuously improve. We made the necessary adjustments when needed. We hired more workers when we needed to. We reduced breakdown time and idle times, and we cut our plant capacity. And to better adjust to the future, we're employing some green resources in our production process, and we hope that helps us grow in the future. And in addition to that, we hope to penetrate some foreign markets, start to export to countries like the Netherlands, Denmark, Belgium, and China, where bike riding is the predominant form of transportation. We plan to license our brand to smaller companies so they could sell it overseas. And we're going to seek to create a Stratton ecosystem in which we not only produce bikes, but we produce bike parts, bike apparel, and anything else that you need. And that's it. Any questions?
A good lead question, so hopefully you can answer. So your competitor, SFT, so by the financials, it looks like you're stronger and leaner, from my perspective, right? Higher cash balance, half the plant, right? And we're looking at half as much liability. So if our group of investors here wanted to buy you out and give you a multiple on even the next year, but you need to be able to beat SFT next year, not in 3 years.
Right.
What would you do today on the game itself? What would you bet? Where would you put the money? Where would you put your cash?
We definitely put it in investor relations and dividends. Again, as I said, that would have boosted us. So according to the rollover, the offline rollover, would have boosted us to over $60, and they would have remained at like 40 something. So definitely.
So if you feel highly confident by next year, you would be.
Absolutely, yeah. I mean, if you look at the shareholder value, the angle of like how it went up. So we actually, yeah, the slope actually. So we actually went higher It went up high or faster, at a faster rate than theirs. And if we would have invested that ending cash balance, because we can't sit on cash, obviously that's not a smart decision. So if we would have invested that in investor relations, or maybe developed a new bike, but definitely investor relations, definitely giving back dividends.
And definitely new product development.
Yeah.
I don't know if I can chime in, but I agree.
Definitely.
So, okay, so far I'm looking at you guys here.
I have two quick questions. One of them is I see that you kept comparing yourself to Cycle City and also the top stock traders or whoever has the most value. I see that your employees are not being taken care of. They are paid the least of all of them, all of the seven.
Okay.
Is there a reason why they are paid so less when compared to the market? And the second thing is, why is your future towards China and Belgium? Why not India? India has so many of them who go on bicycles. Thank you.
So you wanna? I'll answer the first question.
Okay.
So if you look at our training, we actually have the highest training. So from the get-go, we required our employees to enroll in 60 hours of training, and that's really high. So I guess in kind of like motivating, like they were learning new skills, so 60 hours consistently, that didn't drop. So even though we did cut salaries, training stayed high, plus, so they're getting training, they're getting higher salaries. Yeah, so that's your answer for question number one. Question number two?
So the reason why we decided to export and to invest in the countries that we did was because that in those countries the predominant form of transportation was a bicycle, and we feel that maybe the argument against that is if the primary means of transportation is a bicycle, the market's saturated. We feel that we build a way better bike than anybody else in the market, so we'll be able to capture market share anywhere where we go.
Well.
My question is for Ahmed. Just as a point, a couple of companies made the big slip for you, Mr. Belfort. Are you interested in that?
Wait, what? Did I?
Okay.
Oh, do we trade?
If you could go back to the slide that shows your net cash balances. Right there. That one right there.
All right.
Between 2015, 2016, and 2017, there's a significant increase in net income from 2015 to 2016. You came out of the hole and you went into positive territory.
Right.
Almost $12 million. You ended 4 years later with $14.7 million, which is only $3 million above what you were at a one-time high. Why did you not maintain that same strategy that you took in 2016?
So during that time, actually, so a couple of companies went bankrupt, and then they received bailouts, so they could actually produce more bikes. So that was that. So increased competition. But I mean, over that time span as well, we actually decreased our prices just to penetrate the markets. So that also obviously affected like our sales revenue and our gross margin. So I'd say those two factors were really the drivers behind that decrease. But I mean, we did pick it up, so you want to look at the trend overall, right? Not just a year. It was a startup. We've been in business for, 5 years, 6 years?
If I may, one last question.
Sure.
You also had significant ending cash balances early on too, and if you want to inflate the stock price, we know that you can repurchase the stocks early when they're at their all-time low.
Right.
Why did you choose that approach?
So I mentioned that in the slides actually. So we did repurchase every year. We repurchased 10% of the equity that was issued, and 10% is actually the max in the game. So it only allows you to repurchase 10%. I mean, if we would, so our debt, we maxed out debt, but then rebought all the debt the second year, because we didn't need it. So why be leveraged? So we deleveraged ourselves and then repurchased the shares, obviously, every single year after that.
So I have a question. Even though you're extremely profitable, in the last year, your sales went down around 20%. What is your long-term strategy as a business?
So at that point, we knew it was a game, and the ending year was 2021. So if it was long-term, we'd focus on sales. but we actually decreased advertising, which decreased demand, which again decreased sales revenue. And we understood that. We knew that was going to happen. But we chose to do that just to boost our shareholder value. But I mean, long term, we'd obviously want demand, so we'd have to increase advertising, public relations, and.
Your company's a bit of an enigma. Are you the 11 or 14 $14 million net income company, or are you the 1 million, 3 million net income company? From this, it looks like those are just anomalous years.
Right. So.
How do you justify sustainability? I guess is the best question.
I'd say we adjust accordingly to the market. But I'd say if we had to, our long term, we'd be pretty profitable. We'd be between like 5 million, 6 million. Because 14 million, that's an anomaly. It's not, because we pruned a lot. That was our lean company, right? And then our 1 million, that was our growing company. So if we had to do some sort of long-term strategy, if the game would have stretched for a longer period, we would have, 5 million, 4 million consistently.
So let's pretend for a second that you didn't know when the game was ending.
Okay.
What would have been, what's your estimated stock price? Am I assuming it's somewhere based off of $3 million or so? It seems like that last number is just inflated, as you mentioned. So.
Yeah, it definitely is inflated. I'd say overall it would have been competitive with the market. I can't give you a number off the top of my head, but it would have remained competitive because our shareholder value is competitive across every single year. We were easily top 3 across every single year. Yeah.
So I think in your future strategy, you talked about licensing your brand. Would you be concerned about quality issues in other countries and that actually tarnishing the brand you've created?
Not at all, because as we mentioned before, we train our employees. So whoever we license to, we'll make sure that whatever quality the output, it's up to our standards.
Right.
I think that was the max that we could issue. Yeah. Or close to it.
No, that was the
That was the
absolute
max.
max. That was the absolute max. The dividends was the max, yeah. That last year we issued $2.80, so $2.80 per share. That was the max. If we would have had the chance to issue more, we would have. But again, regarding the first question about the next year our shareholder value going higher, we would have issued the max again, which would have been like a $10 dividend.
Which would drive the price of our shares up even
Larry
more.
has a question.
Larry?
Given that
Larry?
you know how many years you want to play for, or just about, do you think with the debt strategy, early debt in the beginning and then using the cash later on, do you think you could have made enough changes to win the game? Because
Not sure.
it feels like you got just about the best you could have out of the 6 years, out of the 6 year period using a debt strategy. Because the debt strategy takes longer.
Right. Well, the thing with debt is we just used it as a kind of a buffer, just in case something would have happened. We obviously didn't want to go bankrupt, but so by the second year we paid it off, or by the third year we paid it all off. But I mean,
But could you have done enough to win the game?
with the debt, I don't know if we would have used that cash any differently. I mean, we didn't have a need for that cash. That's why we paid it back. But yeah. Thank you, guys.
Hi, my name is Fatma. I'm the
Mike.
Oh, sorry. I'm not used to it. So I'm going to start with a quote by Lance Armstrong. He said it the best: if you're worried of falling off the bike, you'd never get on. And that's our motto for SFT. Timothy Jones, our CEO, you just met. I am CMO, and Shakia Charles, she is CIO. Our mission statement is innovation, precision, and execution. Our goal is to be the leader in providing bicycles toward everyone in the family as well as individuals. We exist to offer great quality and high level of customer service. So for today's agenda, we have strategy throughout the years and financial analysis and future goals for the company.
So our first year strategy was to penetrate all the bicycle markets with a goal of 15% market share for each of those markets. Increase marketing to increase product demand, increase plant size to accommodate that demand, and also hire and train more employees to execute. So in 2018, we sold finished goods inventory, reduced numbers of bikes produced, maintained advertising and slightly increased our PR, last year of plant expansion, and repaid majority of our debt.
So the reason that we did this was because in 2017 we actually had a bit of a slip up and we increased our prices in our kids category, and that actually left us with quite a bit of finished goods inventory. So what we decided to do was reduce the amount that we produced that the following year and actually lower our price so that we'd be able to sell the rest of the inventory that we had and continue to make profit the next year.
So in 2019, we paid off remaining debt, began buying back our shares, and introduced to Commuter Market, and that which increased our PR and advertising, and which led to increasing our net profit overall.
So,
sorry, I'm sorry. How do you go back?
In 2019, we had $2.8 million left in debt. What we decided to do was to rebuy that and actually start to buy back shares. That year, we bought back $2 million worth of shares, and we were able to actually introduce into the commuter market, which was actually the last market that we got into. We were the last mover in that case, which is pretty bad because a lot of other companies were able to penetrate it and get pretty big market share in that respect. But once we actually introduced our commuter bike, we were able to capture a bit of the market because we had a really high brand recognition, and we had really good advertising throughout all the markets. So what we did was decided to advertise just enough so that we can make sure that our bike was pretty much being seen by the masses. And with that, we were able to actually increase our overall net profit.
In 2020, we had our first year of dividends and our last year of buying back shares. Financially, we maintained our finance decisions, operations, and marketing decisions.
So in 2020, we felt pretty confident about what we had been accomplishing from year to year. We maintained the $2 dividend, which wasn't the max, but it was pretty consistent. So we felt, shareholders like to see consistency, like to see that you're able to provide them with a good steady growth and show that you're able to sustain yourself over time. It was the last year that we had a chance to buy back shares just because we weren't able to actually make decisions in the following year. But that was okay with us because we knew that the strategy that we had employed by buying back shares a bit earlier actually would help us in the end. And we decided to pretty much maintain all of our finance operations and sorry about that. We decided to maintain our finance operations and marketing decisions just because we felt like we were in a good spot. We had no debt. We were operating on pure equity. So we had any retained earnings that we had, we used that to finance all of our operating activities and marketing, and we were able to actually make money in every single category with a gross margin of at least 39% in each bike category.
So 2021 was our big year. We issued $2 game-changing dividend. Shareholder value position jumped from third place to first, and we didn't buy any of our shares back.
So, like I said, we maintained the $2 dividend throughout the entire time, and this was actually really good for us because we were able to keep a decent amount of cash and not completely I guess spend all of our money is the best way to say it, because we actually were able to hold on to what we had, and with the ending cash balance that we had at the end of 2021, we would have been able to maintain that $2 dividend for quite a while. And that same year, we were actually able to jump from third place to first place with an increase of, I think it was $7. Yes, $7, about $7. So I'm going to go over a few of our financials ratios. This right here is our current ratio. This is just to show how well we were able to utilize our assets compared to our liabilities. So as you can see, for the most part, we were able to maintain a really good current ratio. It averages about 5.5, with the one slip up in the year 2018, which was the year that we actually we went down quite a bit, but we were okay with that because we knew that the long-term strategy would work out for us. And the most recent years was years 1 and 2, which is 2021 and 2020. We have a current ratio of 6 or more, which shows that we were able to use our current assets to produce a lot more money than our current liabilities. So, and our current liabilities were strictly the income tax that we were being charged. So we weren't quite worried about that because we knew the more money we were able to make, the higher that would go. So as you can see, our ROA ratio averages about 25%, and it goes up all the way up to about maybe 32%, I think it is. So in 2018, 19, and 20, we were able to really show that we can use all the cash that we had and maintain our operations just solely based off of what we had. We had no use for debt or anything like that. So what we did was strictly just use our cash to continue operating. Our leverage ratio was quite low once we got into 2017. What we decided to do is just continue to buy back our debt so that we could operate off of pure equity and just show our shareholders that we could use our cash to operate. So this is the trend analysis of our shareholder value and the other top 2 teams. As you can see, we had a slight dip in 2016, and from that point on, we were able to trend upward continuously all the way throughout. And from this point on, our long-term strategy is to continue to operate internally on equity and to pay out that constant dividend so that we keep our shareholders happy and continue to grow our company. Any questions?
Of course, the questions are for Vincent Armstrong, not for us.
The stock price may be on the top, but what would be the lessons you would learn from all of your other competitors?
Okay. So what I would say is we definitely stretched ourselves thin early. So in the 3rd year, if you look at the shareholder value, it dropped significantly. And that year, we actually increased our advertising and PR quite a bit. We increased it $10 million, which was a bit of a stretch for us. Right after that, we actually were able to decrease it. And from that point on, as you can see, it was an upward trajectory. We had no real down years, as some other people may have had. But with that being the case, I feel as long as you don't stretch yourself thin and you don't try to overdo it, then you'll be all right. And I feel like our strategy was pretty solid from that point on. We were able to always predict what the customers want. So if you look at, I know you guys probably don't have a perception graph, but we were able to hit the bullseye on most of our bikes and stay in that area to continue to show customers that we're giving them what they need.
So now you've had a little insight into our little table here. Competition is coming at you to really try to beat you next year.
Yeah.
It seems like the long-term goal that you have right now is pretty conservative, relative.
Yeah.
And they had about $10 million more in cash to kind of increase that value. Yeah. So I guess my question is, now that you have a little inside information and you will absolutely be part of the rendering of that, what would be your strategy for next year?
So for next year, I think what we would do is I would definitely decide to slightly increase our prices, keep our advertising about where it is, because I know that some of the groups in different segments were able to actually have higher prices, although they didn't have quite as much the brand recognition. So with our brand being so powerful and our bikes being so well known, I think that our recognition and our quality standards would have been able to charge a bit more for our bikes. So with that being the case, I think we would have been able to just continue to increase our lead. And with that, I assume that we would have maybe taken over a bit more of the market. So more people would have been maybe leaving their company to come to us, or just entering a new market. More people coming into the market may have just come straight to us. So with that being the case, I feel like we would have been able to increase our shareholder value and increase our cash year over year. Yeah. Yeah. Not really, because we knew that we had a really good quality bike. We knew that customers were continuously buying our bikes, and we were also able to, not only were we able to have people buy our bikes, but we were able to stay at least top 3 in most segments. So once we entered a segment, we made sure that we were able to take a decent market share in that segment. And with our prices being maybe slightly higher than theirs or around the same, I feel as though if we were able to continue to stay the market leader in many of the segments and have higher prices, we would be fine with in the future.
With that given, also just a comment, I think you were the only group that modify your bike year after year just to keep up with perception.
Right.
Markets change, and that was very key to the
Yeah. Thank you.
Thank you.
So my favorite part about the last year, we don't need to make decisions, is that it really just highlights how sustainable the company is. But in the real world, we all make decisions.
Yeah.
So I'd like to know, going into this game, how worried were you that second place's strategy was going to beat you, and how sure are you in the future? How sure are you in the future that you're definitely going to be in the long run?
I think that our strategy was pretty solid. If you look at it, our trend right after that one down year was continuously upward, and I feel like we would have been able to maintain that throughout the rest of the time. If we had gone 3-4 more years, I feel like we would have still been at the top, no problem. With what Mo just said, excuse me, sorry for that. As you can see, we were able to maintain that perceptual map, that key point there. So with customers always knowing that they would get the product that they want and knowing that they wouldn't be charged a ridiculous amount, I feel like we would have been able to sustain growth, and I wasn't quite too worried about that. I'm not sure if the other groups, figured out, hey, we need to modify our bikes every now and then, or keep up with what the market was looking for. But with what we did, I feel like we were all right.
All right, could you please sit down 1 minute, just 1 minute, please. We want to conclude this. I know everyone is eager to kind of learn about the final outcome. Clearly, obviously, you have a result which shows some doing better than others, but the judges are going to take into consideration everything what just occurred, including your presentation, including the way you articulated your answers. Because what the judges are interested is, in addition to what you just learned, what you just exposed. What you expose is called your explicit knowledge, although there are some tacitity in it. By tacitity, I mean like the experience what you have gained and how you spoke during that presentation about that experience, the intuitions, and the idea of doing certain things in the marketplaces, and also the idea of bringing new product and new initiative. All of these will be accounted by the judges. So in the meantime, what I'd like to do is to thank the student who proposed their posters and PowerPoint presentation from classrooms. So we had 10 of them around, and we let them run for you to see. Typically, our plan was to have a student standing by them and explaining them. But we are also looking for a much larger competition. And if we were going to do that, we are going to have posters. And anyway, we have learned a few things along the way, and that will happen more next year than this time. But I will go ahead and say what the people who contributed, the posters which were presented, will all be awarded. So you will hear from our school subsequent to this presentation. We thank you all. So I just want to run quickly on a list of these different projects. They were done in classrooms, so we just took a sample of them, from PhD work all the way to undergraduate, just a sample. So this one is the PhD work, and it deals with sustainability. This project was actually guided by our dean. It's a research what was just done by the dean. The student have just recently graduated. I don't want to read the title for you, but you can see what it deals with: sustainability in industrial supply. We are very cognizant of the impact of what we produce, and people who just deal with bike understand that impact as well. So the next project is by a student who did this in Management 692. It's a strategic management class where she examined Oracle as a company. And she was here standing by her poster. She was the one who was willing to explain, you do stop to ask her questions. And you have a project which is done in MIS 245, which is our Principle of Information Systems class, a basic class, in which the student do different projects using the software for decision analysis, database analysis, network analysis, and other type of things. So this person look at healthcare, primarily the use of radio frequency detection devices, which are soon going to be everywhere. So the next project is, I have here many EMBA students. This is an EMBA class. This was a group of students who analyzed a particular company, mostly a culinary company, I should say, and they process animals, primarily beef. And you may think, well, there's not much into that, but there is a lot. So there are lots of production planning problems, supply chain problems, and procurement issues, transportation issues, what they have dealt with. The next is an application of a decision support system. And here we use decision support system to help, say, people who are planning wedding to be able to decide which restaurant they want to have a wedding to take place. And that means considering many aspects, including the dinner party and other parties. So each different restaurants would have obviously different menus to offer, different cost structure, and different amenities. So in this particular analysis, students would have to rank, evaluate, and rank alternatives, as well as run a lot of databases. So there are software systems which they learn along the way, including tying it all up by doing interfaces using either Excel or any other device. So this one is from a decision support system class, MIS 648. Now this one is a business research method class. This group of students, actually they're here, all three of them. In fact, they are right there in front of me, and did an excellent work. Okay. Like I was saying earlier, they are athletes, and they came from overseas, and so they look at this particular situation of academic issues, what athletes actually kind of do to survive here at NJIT. The experience they go through, and the learning from that experience. Now, the project was displayed, I think, on the panel up there. I mean, if you're interested, let me know. We will definitely be glad to share with you. We made a number of hypotheses. So we built a research construct, collected data, and analyzed those statistically, and then come to determine the hypotheses which are kind of supportable and those which are not. Another similar project is this one, by again another athlete student, and she looks at what we call the career development office, this thing called on-campus recruitment program. In fact, many of these projects are solicited by NJIT services, so they took advantage of the class by coming to get students to do some aspect of customer satisfaction from their services. And I understand what she has graduated and did a master's degree, and now she's married, right? Okay, so this one is an accounting a project done in accounting, lots of financial analysis, accounting analysis, and Karen was a lead professor in that class. And so they look at oxy glass. Okay, so with that I can continue quickly. Karen, you are a known entity. No need to qualify you in any way. Thanks. Okay, so this is a project. I am guessing this to be 492. They sent me the file without the, a class specification. But the students were here, they might still be around, and they were eager to explain their project. So they look at the Airbus industry, especially this late Airbus plane, the A380, and compare it to the other airlines. Primarily, they compare it to Boeing 437, and they look at why the initiative taken by Airbus conduct them to put them in a very competitive environment, which is very successful. Now, this one is a project which was done by a student in my class, MIS 245, and this one is called a College Selector Decision Support System. It is a case when you are in high school and you are confronted by the decision to select which college to go to, and it's an important decision, of course, what you make. The effect of going to college is a life-lasting effect. So students obviously will occasionally meet their lifetime friends, sometimes their spouses. So it's a very important decision. So this particular project is designed using a process called the analytical hierarchy process. So the student have to collect number of information on high schools, price, locations, tuition fees, and social life, and what have you, and subsequently try to play decisions where they and their parents are looking at which colleges to select. So it requires some comparison of the colleges, which means they have to actually evaluate and rank them. And they design a demonstration system using Excel primarily, and they allow you to do sensitivity analysis, which means to change your mind about the factor of a decision, and also to reconcile decisions between the parents and the kids. So in fact, it is what you call a group decision support system. So it's a multi-criteria decision support system as well as a group decision support system. So it has a very nice demo at the end, very sophisticated, combination of, demonstration using Excel. All right, so these were, yes.
Can you please publish this? We have kids who are going to go to market.
Oh, okay, we will look into it. Definitely. We have a website now. Yeah, we certainly can put them there as student project. Yeah. So I want to say what those who contributed to the poster would hear from us pretty soon, and would receive an award just to thank them for their participation. Next year, it will be quite different because they also would have to present their work, to explain it, to take questions, and then to get evaluated and judged. Okay, so with that, I think we are at the end of the process. I believe the judges are going to come pretty soon with a decision. Shanti? Thank you.
Just take so you can give the awards.
Sure, sure.
Okay, and now the moment that we've all been waiting for. Congratulations to all of you. And you were fabulous. Okay? You played a great game, all 7 teams. And I was so proud. Your presentations were impeccable. Okay? And you did a great job answering the questions. So I'm going to go from the team that placed 7th to the team that placed 1st. The team that placed 7th, and this was the average of both the performance and your presentation scores. The team that placed 7th was Lady Hawk. So would Diane Castro, Christine McIntyre, and Tiffany Hoover please come up and receive your award.
The three?
Yeah,
Yes, is it all in one?
Those are the 3 different ones.
Okay.
That's Christine.
I'll take Christine. I'm going to keep Christine's award for me for obvious reason.
Oh,
Congratulations.
Thank you.
Congratulations.
Thank you.
You guys, next time I should tell you, do not appear hesitant. When you were here, you appear always defeated.
Oh,
And
this
that
sounds
you should
nonsense.
avoid the next time around. It's true you didn't get a good result, but it should be funny because she asked a key question. What lesson have you learned from a failure? And And that's a very important, because as John said earlier, what you fail to learn, especially if you demonstrate what you learned that, and confidence coming, the judges take that seriously. Thank you.
The team that placed 6th was Lehman Brothers. Congratulations, Cordell Black, Shakira Upshaw, Karishma Patel, and Sabi Rivera. Karishma, Shakira, Cordell, and Sebastian.
All right.
These are IOUs, so you bring your cards and collect the money from the School of Management, okay? So this team made $150, as did the last team. Team that placed 5th, Texas Rangers, Lawrence, Darius Tillman, and Clemens.
Thank you. Congratulations, man. Darius, thank you. Oh,
Thank you. You'll take Clemens? Yes, please. Or we can take it and give it to you. The team that placed in 4th place was Cycle City. Cycle City is Kal Pandya, Hiral Ghoshal, and V. Cruz. Congratulations. I'm missing one.
Pandya? Carl, thank you very much. Congratulations. Hiral?
Congratulations. Team that placed in 3rd place, DNA. Danica, Nina, and Arno. $450.
Thank you very much. Thank you. Yes, thank you. I was just confused. I put the tool on the camera, but the tool on the thank you. That was smiling. No, it's just and this guy is my best friend.
And now for the top 2 spots. The team that placed in 2nd place is Stratton Oakmont. Ahmed Mohammed, Kashif Usman, and Sim Singh. And they were awarded $750.
Thank you, Ahmed.
And the Oscar goes to our winners for the evening, SFT, for a prize money of $1,050, Fatima Naqvi, Shakia Charles, and Tim Jones.
All right.
I want to particularly thank Mo Isahak for all his help all through the day today. Can we give him a big hand? Congratulations, everybody, and thank you.
Thank you. All right, again, thank you everyone for coming. I especially thank the judges. You have always come to our call, and I see what Shuba is still here, and So thank you all for being here. We appreciate you coming to help, and we would like to stay in touch with you. Okay? Is anybody else? Oh, yes. Thank you also for being here. All right, bye-bye.